Boom! What's up, Waves Capital? It's Royce Jacob, and welcome back to the channel. In this video, we are going to be discussing the November CPI report, which was just released because we're finally beginning to see some signs of inflation meaningfully cooling. You'll love to see it, you guys. The markets love to see it as well because we did get a nice rally in the wake of this data release, which did end up fading out, and this guy may be the reason why. Okay, so the bulls have one last significant macro hurdle to jump through if they want this rally to persist. And that hurdle is the speech that Jerome Powell is scheduled to make following the resolution of the FOMC, or the Federal Reserve's two-day meeting. Okay, so this is occurring on the 14th. I'm recording this on the 13th, so I have no idea what the results of this speech are going to be. But I will say right now that it's not necessarily the rate hikes themselves, because I think most analysts and most investors can agree that the Fed is very likely to raise interest rates by 50 basis points, which is 0.5%. But what investors are going to be all ears in regard to is the tone that Jerome Powell takes. So is he going to be hawkish, which means offensive, or dovish, which means, you know, he's taking it easy and they're really going to slow down on interest rate hikes? At least that's what they're expecting. So again, it's not the interest rate hikes themselves in Jerome Powell's speech tomorrow, or that they release tomorrow. It's the tone that Jerome Powell takes in regard to his positioning and the Fed's positioning moving forward from here. Okay, so this article explains it pretty well. We won't go too deep in this one, but the title in itself kind of sums it all up. So we will discuss this article following a few key points in regard to the CPI report itself. Just go over some of the basic metrics, not diving super deep on the numbers, but just displaying how, again, relative to analyst opinions, CPI is cooling. That is why the market's ripped. But another reason I personally believe the rally faded is because 7.1% is still historically high, and inflation's still scalding hot from a historical perspective. Okay, so we will discuss the CPI data. We will discuss this upcoming Fed meeting and kind of what this might mean for the markets. Take both a bullish and bearish approach here. We will, of course, look at the S&P 500 as well, just kind of the summary of the U.S. equity markets, and talk price action at the end of the video. We will take a look at Bitcoin too. But before we dive into the technicals, I do want to discuss an indicator that we've looked at a few times here on the channel before. I've discussed it a lot in the newsletter, but it has been a while, and that is the Fear and Greed Index. And as you can see here, investors are starting to get a little greedy as we progress through the holiday season. That's obviously not good, and I want to talk about why that is and why this could be, why this could act as a weapon for the bears if they want to regain control. Okay, so we'll take a look at the Fear and Greed Index. I do also want to define the Fear and Greed Index as well, really before discussing it, because again, we've discussed this here on the channel before, but it's been a while, so we'll catch up on what the Fear and Greed Index is, why I believe this is an important indicator, why I've looked at it for pretty frequently throughout the course of my trading career, and so it's done me pretty good. Okay, so we will discuss the Fear and Greed Index in some detail, talk about why, of course, greed is bad, and we'll reference one of the greats himself in terms of kind of a 101 about how investors or traders should perceive greed in the markets. Okay, so that's the video, you guys, and we'll close it out by talking some technicals. But let's kick it off with the fundamentals. Let's kick it off with the CPI report and get to reading. Okay, so key points. The consumer price index rose just 0.1% from the previous month and increased 7.1% from a year ago, compared with respective estimates of 0.3% and 7.3%. So that's a pretty decent beat on estimates when it comes to inflationary metrics, at least. Okay, core CPI rose 2% on the month and 6% on an annual basis, compared with the respective estimates of 0.3% and 6.1%. Stocks roared higher following the report as investors look for signs that runaway inflation is ebbing. Inflation-adjusted average hourly earnings for workers rose 0.5% for the month, though they were still down 1.9% from a year ago. So you guys, again, this did catalyze a massive move in the S&P. I don't feel it necessary to look at it. I'm sure a lot of you watch the markets today and you will know what I'm talking about. But again, I want to talk about why this move did fade out and why it was rejected. Again, this guy is probably one of the major reasons why it's not. Of course, it's not Jerome Powell himself. It's, again, the actions of the Federal Reserve and the stance in terms of whether they come out of the gates and whether Jerome Powell once again displays a hawkish or a dovish tone, a positive or a negative tone looking forward. Okay, it's similar to earnings reports. It's not necessarily the prior quarter's revenue or even profits. It's guidance. Okay, so always keep that in mind. The stock market trades on future prospects and future potential, not previous, not what's already happened. Okay, that's why you got to be ahead of the game as an investor. So again, agree with Patty Dom, the author of this article, 100% when it comes to this title. Well said. The Fed has to portray itself as tough on inflation even as it pushes through a smaller rate hike. So, I've said this many times. Again, kind of just parroting when it comes, parroting myself and parroting what I've heard from people much smarter than me over, past like 6 months, almost a year now, ever since the Federal Reserve began raising interest rate hikes. And that's the fact that as the markets appreciate in value, if the markets rip, when the markets do well, it undoes the work that the Fed's done to combat inflation, because you don't want a roaring market that gives the impression that the economy is good, that gives people the impression that it creates value, it creates demand. And what the Fed is trying to do, and the reason the Fed is this guy is kind of like public enemy number one when it comes to investors in the stock markets, is because they're actively trying to destroy demand. So when the markets appreciate in value, when things are doing good, when everyone's 401ks are going up, that is creating more economic value for the consumer. The Fed doesn't want that. The Fed wants demand destruction once again in order to combat inflation and significantly cool inflation. Again, 7.1%, that's good. It beat analyst estimates, but it's still ripping hot historically speaking. Okay, so key points: the Federal Reserve is expected to raise interest rates by 0.5 percentage point Wednesday, yet signal it will continue its battle against inflation. Economists expect Fed Chair Jerome Powell to tilt toward the hawkish side in an effort to impress on markets that the central bank is not ready to give its rate hiking stance. So again, he has to display that hawkish tone. It's unwise of him, and again, it kind of just really it's a couple steps backward, or he would take the work they've done a few steps back in the case that he was to display a dovish tone, or if he was to ease up, if he was to say we don't plan on increasing rate hikes more, we're doing pretty good on inflation, we don't think we need to go hard as we kick off the new year, as we head into 2023. That's bad, because again, it shows the markets that it's game over and the markets are going to start ripping, which is, again, the catch-22 of what the Fed is doing. Okay, so again, all eyes are going to be on Jerome Powell heading into tomorrow. It's going to be a big day. And personally, I don't know what's going to happen here. Obviously, I can't speak with a whole lot of confidence here. It's really kind of the flip of a coin in my eyes, especially following the CPI report. The CPI report was cool. It beat analyst expectations, so that gives you reason to believe that Fed Chair Jerome Powell could come out with a more easygoing tone. But the recent jobs reports that have come out and some of the employment data that has been released in the past week or two was pretty good. And that's a big reason the market sold off going into this the current week. But again, you guys, I'll just close it out by saying this is a flip of a coin. And personally, I'm positioned for both scenarios in my personal portfolio. Okay, in the Waves portfolio, we got some calls, we got some puts on deck, and I will just adapt as I feel necessary, given the tone good old JP takes. Okay, so again, we'll take a look at the Fear and Greed Index, but first, I do want to talk about what the Fear and Greed Index is. This is my newsletter from December 8th, so almost a week ago now. because, again, it's been a while since I've actually referenced the Fear and Greed Index, and I just wanted to remind all of you guys what this is. So, what is the CNN Business Fear and Greed Index? The Fear and Greed Index is a way to gauge stock market movements and whether stocks are fairly priced. The theory is based on the logic that excessive fear tends to drive down share prices, and too much greed tends to have the opposite effect. So again, Fear and Greed 101. Extremely fearful, if you're talking about longer term time horizons, that's probably a good time to start buying. And once you get into greedy, extreme greed territory, that's probably a good sign that you should think about maybe selling the top, because you never want to be on either end of the spectrum. You never want to be on either polar extreme when it comes to pretty much anything in life, especially greed and fear metrics within the markets. Okay, so how is the Fear and Greed Index calculated? The Fear and Greed Index is a compilation of 7 different indicators that measure some aspect of stock market behavior. They are market momentum, stock price strength, stock price breadth, put and call options, junk bond demand, market volatility, and safe haven demand as well. The index tracks how much these individual indicators deviate from their averages compared to how much they normally diverge. The index gives each indicator equal weighting in calculating a score from 0 to 100, with 100 representing maximum greediness and 0 signaling maximum fear. So, as you can see, investors are starting to get a bit greedy as we head into the holiday season. And to reference the Oracle of Omaha himself, Warren Buffett, be fearful when the markets get greedy, and be greedy when the markets get fearful. That is a cliche in the entire investing landscape. It's one of the first quotes you probably hear when you enter the investing/trading space, when you enter the financial markets. But it's a cliche for good reason, and that's because it's, again, almost the golden rule when it comes to market psychology. All right, and I did want to bring this up because I am very hesitant. I did say that I obviously don't know what's going to happen here. No one does if you speak with any certainty when it comes to these macroeconomic catalysts and the game theory that's played and the psychology of investors following events like this. You're full of shit. But if I was being just my personal opinion here and the way I'm trading it, I do think that the markets do see one more wave down in the short term following this meeting. Maybe we see a very, very quick pop following the announcement of rate hikes because that'll go as planned. But personally, I do think Jerome Powell will take somewhat of a hawkish tone. I do think that although it's not really going to catch investors by surprise, the current fundamental and really technical landscape as well, which we'll jump into right now, does still favor the bears, although today's price action did show some signs of promise. The macro still favors the bears, at least in the short term, and I do still think we have one more flush out prior to maybe a rally in early 2023 due to not only these reasons, but also like tax loss harvesting as well, where everyone's cutting their losses and trying to offset some of the income they've made over 2022, because as we all know, all of us have probably lost some money in the markets over the course of 2022, especially if you're trading growth stocks and small caps like we are primarily doing here at Waves Cap. Okay, so again, don't know exactly what's going to happen here, but I am prepared for both scenarios. If you guys want to know how I'm trading my personal portfolio or the Waves Capital portfolio on a day-to-day basis, because again, very excited about some of our long positions, but again, I'm strapped with puts in the case that we do see some more downside in the short term. In the case that the bears do maintain the reins and hold control as we head into Christmas. Check out the first link in the description box down below, you guys, if you want to join Waves Capital for real. This includes a complete breakdown of my entire personal portfolio. Again, all of my call options, all of my put options, all of my stock positions, all of my cryptocurrency positions, which I do update every single trading day during market hours. And along with each update, I send out multiple newsletters explaining my thoughts, rationalizing my trades, and also talking to you guys about some real-time price targets on some of the dominant names within the portfolio itself. Okay, so again, that's the first link in the description box down below. From there, you can choose any of these pricing plans you want. It's completely up to you. You can even try it free for a week, and if you don't like it, you can just bail out. That's perfectly fine. But I do trust you guys will be sticking around, and if you do join, then welcome to the winning team in advance. Okay, so that said, again, if you want to join Waves Cap, that's awesome. If not, no worries at all. I appreciate you watching this video. Let's close this one out by taking a look at the S&P and talking about how we have now been rejected twice in the past week alone, just over a week, I guess. We have been rejected twice following a technical break above macro resistance. So let's quickly zoom out, and then I'll talk about these two potential price scenarios that I see playing out, if I'm being honest, by the end of this week. Okay, so macro resistance. Macro resistance pretty much just means long-term overall resistance dating back to the S&P's all-time high back in January of 2022. Okay, so January 4th, real early in the year. It's almost been a year now. Crazy, but since then, the S&P has been in a persistent downtrend, okay? Series of lower highs and lower lows, a lot of volatility, obviously, massive descending channel, but there is a very, very evident line of resistance that has come into play here. Again, created by multiple, there's 3 touch points right here. Every trader and their mom, if you've never looked at a chart before, you can identify this line of resistance. So everybody is going to be eyeballing this. And it did confirm itself twice here. Although we did break above, once again, the SPY has technically broken above this line of resistance, but it has not yet closed a daily candle or even a 4-hour candle, which is what we're looking at right now, above this line of resistance. Which in my mind, a 4-hour closure is a good sign, above or below resistance, or a good indicator as to whether a trend direction can be confirmed. But when it comes to a trend line this significant, in my mind, you need a daily closure above, once again, or below the trend line, given the nature of where the trend's going. Okay, so we have closed below this twice. We are still below previous supports on the SPY. Once again, we did break below a significant line of support that has been held since mid-October. Did break below that, came up, would technically retest this. You would see that even upon this bounce, the SPY just pretty much retested prior support as new resistance right here. And that is an objectively bearish sign, you guys, okay? Again, the outcome of tomorrow's speech by Jerome Powell will have a major impact and pretty much entirely dictate the direction of not only the S&P 500, but of Bitcoin, of pretty much everything else, the US dollar, of course, as well. So, again, we really have to wait and see how tomorrow plays out. I personally do think downside, I put the odds at like 60-40 to the downside, and again, that's how I'm personally kind of structuring my portfolio. 60-40 downside odds, just because, again, there's so much resistance right here that, technically speaking, on top of the fact that inflation is still objectively historically hot, even though it is cooling down, and the Fed is still going to raise interest rates, it's like the downside just makes more sense, especially when it comes to the short term, on top of, once again, the tax loss harvesting aspect of just the investor action right now. Okay, so in the case that we do see downside, I do think it's actually pretty likely that we come down and close this gap right here. So it's not actually just that right here, but this gap is my downside target for the SPY. Do we see this by the end of the week? I don't know, but I would say it's possible. So no, I don't want to grab that. I want to grab this price range. So I will say that I do think a 4 to 5% move to the upside or the downside is coming by this Friday. I will say that. Again, I don't know which direction it's going to play out at. I don't know which direction we will head, as I just said many times, so I kind of hesitated right there. But I do think that a 4 to 5% move is coming in one direction or the other. If we do break to the upside, I do think previous support will be tested as new resistance. That would take us up to about 420 on the SPY by this Friday. And if the downside is tested, I do think that we close the top end of this gap, maybe to the bottom end if things get really dark. And that would take us from about 377 to 384 in the SPY. That is my downside target range. Okay, so we'll see what happens there. Again, it's completely up to the tone this guy chooses to take. But I do think a 5% move, 4 to 5% move is coming by week's end. Okay, let's take a look at Bitcoin, which is looking pretty damn good right now. Bitcoin is looking honestly much better than the markets, or than the equity markets, than the S&P, than the NASDAQ from a technical perspective. And again, given the outcome of what happens tomorrow, because the Bitcoin does still hold a very strong correlation to the equity markets, I do think one of two things is going to happen. One, the bull case is that Bitcoin plays out this very, very funky inverse head and shoulders pattern and ultimately resolves around $20,000 to the top end or the base of this inverse head and shoulder. So again, these shoulders are very unsymmetrical. This is a very kind of janky head and shoulders pattern. But again, you guys, when it comes to technical patterns, so much of it is like the psychological aspect. I always say this, but it's technical patterns are pretty much just psychology and psychological tendencies visualized on a chart. And that's why even if it looks janky, even if it's not perfect, the principles still apply. So there is somewhat of a head and shoulders pattern playing out here. Bitcoin did break above the top end of the sideways range it's held for quite a long time. And right now we are printing somewhat of a short-term bull flag. So just a big move up followed by sideways price action. So maybe we see that second wave. Maybe we get a second wave. If we do, I do think we will reclaim the $20,000 level and probably float around there for quite a while. Good old SBF just got arrested today. That's great news because that dude should absolutely be going to jail. And, that's probably good news for the crypto markets as well. But, guys, if this guy comes out the gates hot, if he comes out with a hawkish tone, the markets are going to go down. That's the reality of the matter. And because I'm bearish on the SPY, on the NASDAQ, at least in the short term, again, just talking like over the next few trading sessions to maybe a week or so out, I do think downside is the slightly likelier scenario. And in the case that Bitcoin does see one more wave down, I think prior support right here, prior to this breakout, will act as prior resistance. Will come into play as new support. I can always jumble those up, but prior resistance, this red line right here, will come into play as new support, which would take us back down to like the lower end of this range in the case that we see it come by this weekend, resulting maybe in like a $16,000 Bitcoin. Okay, so that's my thoughts there, you guys. Please let me know what you think down below. Again, if you want to know how I'm trading in my personal portfolio on a daily basis, that's the first link in the description box. And as always, I'll catch you guys downstairs in the comments. Please give me your thoughts on what's going on in the markets right now, what's going on from a fundamental perspective. If you're keeping an eye on the charts, what do you think about the tape? And always look forward to talking to you guys downstairs. So I'll see you down there. And until next time, always remember, take action, make waves. Peace.